Hi guys, I'm just going to let just give it a minute or so for everyone to sign in, and we'll get this underway. Good morning, everyone. Hi, Bando. Good morning, guys. Good to see some regular faces here, or regular names, I should say. All right, let's get this underway. So, to begin with, a very good morning, or afternoon, or evening to everyone here. Many thanks for taking the time. Of course, many thanks for taking the time out of your day to be with us. So in previous webinars, we covered the Forex Basics part 1 and part 2. So in parts 2, I believe it was, last week we nosedived into the basics of technical analysis, covering a brief history of technical analysis and also the basic principles of TA, namely the trends, where I looked at basic trend structure, including retracements and pullbacks. We also stepped into the world of chart patterns and candlestick formations, looking at flag and pennant patterns, and two of the most widely used candlestick configurations, the hammer and shooting star. So right now I'm seeing a little conversation going on in the chat box. So I guess I'm coming across loud and clear, and the welcome slide is visible. Guys, if not, please do let me know in the chat box, and the support team will try and assist you to get you back up and running. Now, today's presentation is all about support and resistance, which you know is the backbone of many active trading strategies today. Can I ask how many of us here actually use support and resistance in their trading? If you could just type Y or N in the chat box, that would be great. I'm pretty sure most of us do, especially if we trade via the technicals. Also, it'd be good to know about your experience. Like how experienced are you? Are you active traders? Yes, try to. Pete Smith. Yeah, me too. You know, let me know your experience. Let me know how it's been so far. Are you trading live? Are you trading demo? So I can get an idea of who I'm talking to. There's a question here. Are you going to be doing a multi-time frame support and resistance analysis? I believe that is on the agenda, if there's time, of course. So, okay. Just started learning, Victoria. That's great. This is a perfect webinar for you then. Okay, so we have so, you know, for me at least, support and resistance is not, how can I put this? It's not a fixed trading strategy where you have only one way of determining support and resistance. There's several forms of support and resistance. I've personally found some approaches perform better than others, though often a filter is needed to avoid the whipsaws that can and often do occur. Okay, I'm just reading some of the comments here. Trading live since 1 year, and yes, brilliant. So we got some, you got a mixture here. Trading live since 1 year. That's fantastic. Still learning. Brilliant. Okay, so this really should benefit some of the learning traders here. Well, we're all learning, I guess. We never stop learning, but hopefully this will benefit you guys. So as I said, there are several forms of support and resistance, and I have personally found some perform better than others. Ultimately, this webinar, as I've said, is geared to more of the newer traders, just getting their feet wet, but I sincerely welcome all traders of all levels. A recording of this presentation will be available, which can be found on FPM's website under the resources panel, or on the FPM's YouTube channel. Support will also send out an email following the conclusion of this webinar with details regarding a recording. Now, as usual, guys, this is, please just let me run through the disclaimer on screen. So basically, all this is saying is it informs viewers that information presented in this presentation is intended as an educational basis rather than investment advice. So ultimately, what we discuss in this webinar should be considered educational advice. Right, so for those not present in previous webinars, I'll just quickly run over who I am, and so we all know who's on the other end of the microphone. And I'll briefly introduce the topics of this presentation. So as you can see, my name's Aaron Hill, and I'm part of the research team here at FP Markets. I have CMT levels 1. I have passed CMT levels 1 and 2, and I have recently also passed CMT level 3. That should have been updated. I apologize for that. I've also received the CFTe qualification in 2020. Now, for anyone interested in the CMT, that's the Chartered Market Technicians program, and it's incredibly in-depth, and it's not an easy course. I found it very difficult. So yeah, just it's certainly worthwhile if you're really interested and you're really serious about technical analysis. I would wholeheartedly recommend that. So I'm also as I'm sure you're aware, I'm the technical analyst for FP Markets. I specialize in price action, Fibonacci, so Fibonacci concepts, the relative strength indicator, the relative strength index, the RSI, and also chart psychology. Also, guys, as we're here, please feel free to check out the Trading Hub, FPM's Traders Hub. We have fundamental and technical analysis, and it's available on a daily basis. We also have a weekly release, technical release, and it's packed with educational content and things like that. So it will really help you get a footing in this industry. So on to the agenda. So as for topics for the presentation, four subjects are on the radar today. Support and resistance being defined being the first. Support and resistance, or often referred to as SR, is one of the most talked about concepts in technical analysis. So here I'll attempt to define what we mean when we talk about SR. And then we'll shift over to the types of support and resistance. So although the definition of SR remains the same, irrespective of the approach, traders, especially newer traders, can become overwhelmed with the sheer number of SR strategies available. While it's obviously beyond the scope of this webinar to go into detail regarding each approach, I'll cover as much as I can and to try and give beginner traders a stepping stone from this webinar. We'll then move on to how to plot support and resistance levels. As I'm sure you can appreciate, there are several ways to apply SR. For me, there's no right or wrong way. So here I'll highlight a few common examples of how traders approach applying SR to the charts. And then finally, I believe this was a question just a minute ago. We'll be looking at multi-time frame support and resistance levels. Now, I wasn't sure whether or not to add this to the presentation through fear of confusing some of the newer traders. But it's such a handy method to understand, and I use it daily in my markets analysis to ultimately guide trading direction. Some traders will use multi-time frame analysis differently, and that is absolutely fine. But what I'll do is I'll show what I look at, and hopefully you might be able to take something away from it. Also, ladies and gents, after this, the multi-time frame approach will be, I'll take any questions that should they arise if I've missed any throughout the presentation. We all started off as beginners, of course, so for me, there are never any silly questions. In fact, the study of markets is never is never ending. So we're all still technically students of the game. So yeah, basically, please fire across any questions, and I'll be happy to try and clear up any confusion. Okay. So any questions I'm unable to get to, or if there's a point you thought I should have covered or didn't cover enough, please let us know at either Market Analyst at fpmarkets.com, or alternatively, you can email the support team at support@fpmarkets.com. Now, the Market Analyst email, the Market Analyst at fpmarkets.com, is direct to the research team. So it will either be me or one of my colleagues in the research department that receives the email. So you'll likely get a quicker response in that sense. Please also use these emails to request any future webinars that you may feel could benefit yourself or benefit your fellow traders. Okay, support and resistance defined. Right, let's jump into the first topic of the day, and this is, as I said, the definition. So a support level, going on my definition, is simply a price level that has shown buying interest. Think of the way I always think about support is it's a floor in the market that has withstood, as you can see here, withstood downside attempts. So it's a floor that's withstood downside attempts multiple times. To me, first point of contact, second point of contact, 2 or more tests of the same level is considered support for me. Some will argue that the first bounce here, is considered support, and that the second point, where's my cursor? And the second point here is likely to hold. As I said, there's no right or wrong here. I'm certainly not here to say that someone's looking at support and resistance incorrectly. Just different traders have different perspectives. However, major support levels are often those those that have welcomed numerous tests and held. Minor supports have little history. So as you can see here, this is what I would call a major support level, given the number of clear tests. A minor support level might only be 2 tests, which would be effectively a double bottom, right? So we have to take those things into consideration when we're looking at support and resistance. Now, resistance is simply, as I'm sure you can see, is simply the mirror opposite of a support. It is a level that has demonstrated interest from the sell side of the market. Again, as I said, with the support, 2 or more tests would be required for me to confirm a resistance. Obviously this would be, for many traders, this would be considered minor resistance with 2 points of contact, but with 3 or 4 or maybe more consecutive tests, this would be considered major resistance, and a lot of traders will be watching these areas. Let me just check the Q&A. Okay, we have another question. Does the support or resistance become stronger the more times it is touched or is likely to break? That's a very good question. Right, let me get back to that one. Let me save that till the end, because hopefully I might answer that through the presentation. Just bear with me on that one. Okay, so where was I? So let me just spin things over to the next slide and see where we are. Okay, so this is a live chart. This is back in 2021, so it's a little bit dated now. I thought I would show charts because pre-drawn examples can sometimes be a little misleading and not really echo real life scenarios. So on the slide we have the euro dollar daily chart, and we have 2 points of support formed at this point here. As you can see, these are clear support. This is a clear support, right? Even newer traders will recognize this is a support level. So if price returns to this level, we could actually see a reaction. We could actually see a reaction form from this area, knowing that this was a base where buyers were active in the past. In fact, for those who follow chart patterns, you will note that this was almost a textbook, not almost, it really was a textbook double bottom pattern, which worked out, as you can see, beautifully. So this would have been the neckline, the two troughs. So once price closed above this neckline here, we had a long signal in play, and yeah, we easily achieved the take profit target at this point. Okay, so on the as for resistance at this point here, I'm just trying to think of the best way to explain this. So as for resistance, we can see a level formed around the 115 region. This is not as clear cut as this support here, and that's in terms of structure. As you can see, price did actually whipsaw above this level at this point here. This is where experience comes into play, and this is where you have what my mentor actually said, a trader's eye. You begin to see where support and resistance is, and you don't just look for those clear-cut examples, if that makes sense. So ultimately, SR levels exist as a product of supply and demand. If there are more buyers, more buyers than sellers, price should rise. If there are more sellers than buyers, in this case here, price tends to drop. Just to further emphasize the point of floors and ceilings, we can also see we have a resistance posted at this point here, with support also formed around this area here. Just to be clear, there are several ways of plotting SR, as I've already alluded to. So with that being said, I'm just trying to avoid confusing newer traders, because I know we have some new traders here. But for the sake of this webinar, we're simply locating floors and ceilings. So simply think about it as floors and ceilings of the market and seeing what their reaction was. So the first area of resistance held price lower on a number of occasions, as you can see here, with the final reaction shown by the arrow there, generating a substantial move lower. This therefore was a clear ceiling to be aware of on the daily time frame. The second area, as you can see here, was a support base and was probably, thinking back, a lot clearer on the H4 or H1 timeframes. Nevertheless, we can clearly see this was an area of support buyers showed interest in, and therefore may do so again in the future should we reach this far south. Now, I cannot remember. I'll have a look in the charts maybe later during this presentation to see if we've actually reached these areas, but I can't remember if we have. So, okay, now with a clearer idea of what support and resistance is and a general idea of how it forms, let's swing things over to the different types of support levels that exist. Look, because we're going to look at identifying different types of SR levels here, I thought it would be a good idea to combine how to plot support and resistance levels. As you know, the two concepts, they merge, they of course do merge nicely. So as most of us will know here, markets ebb and flow. They go up, they come down, and they move sideways. So they're in a range bound. Let me just check the questions. What's the difference between SR and supply and demand zones? That's a very good question. Pete, can we hold that question until the end? And I'll try and demonstrate it to how I view supply and demand and SR. It's a very common question, by the way. Okay, so as I said, markets ebb and flow. They go up, they go down, and they also range. The ways we make sense of these movements, of course, is by analyzing the levels in the market where price bounced higher or rotated lower. This is pretty simple stuff. So first up, and this is something I believe most of us learn to work with in the beginning. We have traditional swing highs and lows. As you can see from the slide, this is the British pound against the US dollar on the H4 time frame. We can use these swing points to avoid. As I said, these are traditional swing highs and lows. Nothing special really, but we can use these swing points to extend potential support and resistance in the market into the future. So you will find that at times, of course, price will return to previous swing highs and lows and hold. This is actually where most SR levels originate from. Why I say most SR levels is hopefully you will understand by the end of this presentation, because not all SR levels are derived from swing highs and lows. For those new traders here, swing highs and lows can be easily spotted on all time frames, just to let you know, from the 1 minute right up to the monthly time frame. So a swing high, denoted by the red arrows on the chart, is the peak in price. Peak price reaches after a movement higher before it prints a retracement. This move higher into the swing high is an important level and is often used by traders to hunt reversal setups or as, of course, profit objectives. A swing low, of course, is the mirror opposite. But with a swing low, price will swing, of course, swing to a low point before moving higher or pulling back to create the swing low. And the swing lows on this chart are denoted by the black lines. Most of us here will associate swing highs and lows with uptrends and downtrends, and that's absolutely fine. And the slide, as I'm sure you can tell, shows a clear uptrend in play. Now, I guess some of the newer traders here may wonder, how do I determine a swing high and low without waiting for a number of candles to form? One particular technique that I often employ, and many other traders I've seen employ, is the pivot point reversal, as you can see here. So this has nothing to do with the floor trader pivots, the R1, the S1, and all the pivot point levels is an extended range. So I'm not talking about the pivot points I'm going to discuss now, but the pivot points, the R1, S1, R2, S2, and the pivot level. This is not that, okay? So the word pivot actually, of course, means the point at which things turn. So essentially, what we look for on the charts are V-shaped reversals. Take the example on the slide here. This is a zoomed-in snapshot of the a swing high from the previous slide, and this is what's known as a bearish pivot reversal. Note we have reasonably defined moves, right, heading into this, to form the swing high. So it is at point 1, as you can see here. Point 1, we see a high form from this candle here. We see a high form, and like all the other previous candles, right? So we don't really know what's going on at this point here. Subsequent action prints another candle high at point 2. Again, we don't really know what's going on at this point here, but at point 3, we get a strong bearish close below the low of candle 2. Now, these 3 candles confirm or highlight that there's a bearish pivot in play. Would you sell the low, the open of the next candle following the close of candle 3? You could. Some traders, some more conservative players in the market, they do look for a candle close to form below that of candle 3, as you can see with the point 4. Again, guys, this really can decrease your decrease the risk reward ratio if you're waiting for the candle 4 to form, of course, from a bearish pivot. That's why many traders, and another technique, of course, is to sell on the break of the candle low from 0.3. That's another technique, but as I said, some traders do look for the candle close below, as shown in candle 4. For a bullish pivot reversal, it's simply the same as a bearish setting. It's just turned on its head. Let me just be clear here. There are a number of ways I believe traders use. I believe how traders define support, swing high and low points. And this is just one of them. This is just one of the ways we can do that. And I've only briefly covered this, but this should give you an idea of what to look for if you're looking for to confirm a swing high or low. It's just a pattern I prefer personally, and I prefer it's proven most consistent for me. Okay, so now we have the idea of what swing highs and lows are, and that they can form possible support and resistance. We must be aware that traders don't only stick to candle extremes to help form support and resistance from swing points, from the candle extreme. So these swing points here that were highlighted in the previous slide, we know that there's some traders use the candle closes as well, as you can see here, to form an area of support. So as demonstrated on the slide, we have a number of swing high and low areas. Now, this extends our perspective, if you will. This helps gives your trades more some breathing space. Should you wish to try and fade these swing and resistance levels. This is actually quite a common technique traders use, and one that I would highly recommend, especially for newer traders. I would not be looking for to the pip reactions from these swing high and low points. That is highly unlikely going to work out in your favor. So look, in fact, I know a couple of traders that actually trade in the way that they look for bullish and bearish pivot points to form off of these areas extended. So off of these swing high and low points areas. I know a couple of traders that look for the bullish or bearish pivot points to form and then trade from those areas. As you can see here, there's one example here. Price did actually tag the lower side of the support, but did form I'm not sure if you can see this, guys, but did form a bullish pivot point in this area and eventually did, as you can see, rallied higher. Okay. Moving forward, let's now take a look at trying to bring some of this together on the charts. So on the slide, we have the Euro-Dollar daily chart, which I have applied a clear, for me, it was a clear area of resistance that lasted from early 2015 right the way to until when it was breached, as you can see. So through here, we had resistance until when it was breached at 0.5 in 2017. Note the area held price lower on 4 occasions, as marked here, but as you can see here, failed to deliver on the 5th test. The key thing to note here is what happened following the breach. So the area was breached and then subsequently was retested as support. So this is a key point to note. Once a resistance level is breached, it can generally offer the market some form of support. As you can see here, the area was retested at 0.6, 7, 8, and also at 9. This is an area buyers will be looking to form long entries. And this is a common technique used called the break and retest approach. This is especially popular in trending markets, which I'm sure you can imagine if price is trending higher, breaks the resistance, it's governed by sentiment and things like that. The retest of that resistance, it generally does tend to hold and offer traders an opportunity to trade. As you can also see, the resistance area is not a definite price point. This is important to understand. Most traders rarely look at individual levels, so say the 1620 level or anything like that. So they often form zones around those areas, around those support and resistance levels, in attempt to catch major turning points. There's nothing worse than entering long in a trade, which I'm pretty sure most of us have endured. There's nothing worse than entering long on a trade and you've placed your stop far too close to the support point and you're stopped out only to see price rally in your favor. There's nothing more frustrating than that. So in the resist on the slide here, I have caught all of the turning points at point from 2 to 3 to 4. And subsequently, it offered us a nice zone to focus on, and also provides an area. So this is what I mean by the stop loss. So it gives us a nice area to position our stop loss, our protective stop losses. I assume we all use stop losses here. If not, I would highly advise you to consider using them. I do know a couple of traders that do not use them. But they're very, very disciplined. This is the difference. They're very disciplined in the sense that if price is not going, if the trade is not going their way, they will cut the trade. There is no ifs or buts. They do cut the trade. Many of us do not have the discipline to do that. We think it will turn in our favor, only to see price cut through our account, and then we're in a vicious cycle of, do we hold the position? And unfortunately, some of us will continue to hold it and hope that price returns to break even. Very dangerous and not something I would recommend. But look, the point is, this area offered us a defined area to position stop losses. So, okay, next slide. So the same can be said. This is the same area from the previous example. As you can see, we had the points of resistance here, the points of support here, and this was extended right through to current prices. As you can see, if you remember from the previous slides we looked at, this was the double top pattern. So this double top pattern we just looked at recently, that was a support level, actually formed within a larger, higher time frame support. Again, this was resistance. If you can see, points 1 to 2, points 1 and 2 formed resistance, confirming this area's importance, and then again broke higher and retested the area as support at points 3 and 4. So what we have here is an area that's provided support and resistance since 2015 to mid 2021. All right, this is a long-term zone, a daily zone, but this just can be as easily applied to the lower time frames, or even blended together, approaching the market from a multi-time frame standpoint. This is something, as I said, I'll be looking at nearer the end of the presentation. Guys, I hope what I'm saying is coming across loud and clear, and it's clear. Any questions, please do fire them across, and I'll get to them at the end of the presentation. Okay. All right, next up. So this is something I'm a big fan of, the Quasimodo pattern, and which I use a lot in my daily and weekly market analysis. So, guys, do any of us trade Quasimodo formations in their own trading? And has anyone found any success from this? Just let me know in the chat box. Y or N is fine. If you've never heard of it, that's fine too. You'll leave here with a basic understanding, and hopefully go on to look into it further. So there's no response. So I assume that none of us use it. Okay, that's fantastic. Oh no, double top and bottom. No, not the double top and bottom. I'm talking about the Quasimodo. They're very similar to the double top and bottoms, but they're not the same. Right. So the Quasimodo pattern is not really well known. It's not really a well-known way of determining support and resistance, despite there being quite a few articles written on the formation. So the Quasimodo is also sometimes called the over and under pattern, chart pattern, or simply a malformed W pattern or M pattern. So so for me, though I simply see this as a fake out setup, so we have a bear trap for a bullish Quasimodo pattern and a bull trap for a bearish Quasimodo pattern. Now, a bull trap and a bear trap, I hope this makes sense. I hope this is pretty much self-explanatory, but a bear trap is where traders will see the low here. They see the break of that low. And this is what generally attracts breakout sellers at this point here. But given price hits a floor and rallies higher, this is what's called a bear trap. So it's a seller's trap. It's a breakout trap, if that makes sense. And the same goes for a bull trap here. We've broken above this high. We've triggered a truckload of buy stops here from breakout buyers looking to enter the market. And what happens is they get absolutely trashed. And it's not a pleasant place to be. And this is why I emphasize multi-time frame analysis, because if you're buying something above here and you're buying into a higher time frame support or resistance that you're unaware of because you're only trading the M5 or the H1, then you've only got yourself to blame if you've not done the work or the analysis to understand that you were actually buying into a higher time frame resistance area. Not a place to it's not a nice place to be. So the structure of the Quasimodo pattern is relatively straightforward. So kicking off with the bearish Quasimodo pattern, a market moving higher will see higher highs form at this point here, higher lows, higher highs, higher lows, and higher highs. Once one of the higher lows is penetrated, you are then working with a potential bearish Quasimodo resistance level, which is found by extending the left shoulder. So the left shoulder of the extreme from the pattern. So it's the final peak prior to the extreme high. And you extend that to the the right. And this level is now tradable upon return, should price return to the level. Now, there are a lot of subtle nuances I look at to confirm these types of levels. But overall, this is the basic understanding of the bearish Quasimodo pattern. They are reversal structures, and they can be both used as trend reversals and also in scenarios where you look to buy dips or sell on rallies. So you've defined a trend and you're looking for the bullish Quasimodo pattern. So we have price rallying, and we're pulling. We're forming a retracement, and we have this form on the higher low. So this is another way of determining whether we have a swing low in the in process, and again for a bearish Quasimodo pattern on a sell-on rally scenario. Okay, so look, the same structure for the bearish Quasimodo pattern is exactly the same for the bullish Quasimodo pattern, only again, just look, it's the mirror opposite. Over the years that I've been using this pattern, I feel it's certainly a top way of determining support and resistance if positioned in the right location. What I mean by the right location is either within, as I've already said, is either within an uptrend for the bullish Quasimodo pattern, a dip on or retracement, and within a downtrend for a bearish Quasimodo formation on a pullback. Okay, so here on the slide, we have the Euro-Dollar H1 chart. I cherry-picked a couple of these, and this is a really historical chart. So I won't go... excuse me, I won't go into too much detail here, but what we have is a bearish Quasimodo pattern at this point here. Here you can see we have the left shoulder at this point here, the low, the high, and the subsequent push lower. As you can see, we did get a reaction from this area. albeit not the great, a pretty good reaction actually. It was a H1 time frame. We also had this one here. These are bullish variations, bullish. We just missed this area here. Again, guys, these are cherry-picked examples. I'm not saying that each one will work. But yeah, this is something I would certainly look into if you're interested in finding a reasonably objective way of looking at the at support and resistance. Now, as I said, this is a basic introduction, so I've purposely not gone into too much detail with this pattern, but do be aware that these formations can serve well as support and resistance also serve well as when breached and retested. If I just annotate this so we're all clear on what I mean. So say once we break, let's use this example here. As you can see, price did not actually test the area here. So this is still a clean area for me. Price broke lower and should retest the level as resistance. Now, these are very, very high probability setups, especially when the Quasimodo support is not tested. It's a clean break. So imagine a very clean break at this point here. Let me get rid of that. So I just want it to be very clear for you guys. So imagine a very clean break, a one candle break at this point here. You will often find that price quickly snaps higher to reclaim those unfilled orders at this point here, and then pushes lower. So these are very high probability setups. The Quasimodo support turned resistance, this setup would be labeled as. Okay. Okay, so we're going to change things up slightly here. So on the next scale, as on the next slide, we're looking at the British pound on the against the dollar for the H4 time frame. But here we're looking at something that's known as dynamic support and resistance formed by moving averages. It's also worth noting, as I'm sure most of us are aware, is moving averages can help decipher the trend direction. But this is for another webinar. I won't go into too much of the calculation behind the moving averages. This can easily be found on the net, but just be aware the most common form of moving averages are the simple moving average, the SMA, or the exponential moving average. Now, the exponential moving average adds weight to the more recent data. So typical settings for moving averages are from 20 periods, so that could be 20 days, 20 minutes, to 200 periods. What I mean by periods is simply the number of candlesticks used within the calculation. It's simply an average of the candle, of price action. So on the H1 chart, a 20-period moving average refers to the previous 20 candles or 20 hours. A 200-day moving average refers to the previous 200 days or daily candles. As we can see on the slide, we have this is the 200 period moving average applied to the H4 chart. So this moving, so what I'm trying to get across is these moving averages can, in the right locations, offer you support and resistance, offer additional confluence on top of your current support and resistance understanding. So here is an example. Here are two examples here. As you can see, price bounced higher here, broke above the 200 period moving average, and retraced and retested this area. What happened though is it combined with combined very closely with this area of support at this point here. So it's just added confluence. And again, we had a bounce here, a whipsaw, but a bounce there, and more notably a bounce here, which converged with this support, this swing area at this point here. It's pretty simple stuff, and it's just something you can add to your trading approach that can help benefit your can help add weight to your setup. So I don't really want to waste too much more time on this, but the main idea is I want you to take away from this is to keep an eye on the moving averages, whatever settings you use. as they can do and often do serve as support and resistance. Okay, we're now on the final part of the presentation, and we, namely multi-time frame support and resistance. Now, I know some traders may already use this and will probably use a similar or even, a similar, maybe even a different approach, which is great. And just to be clear, traders, this is not really what I would call basics, looking at multi-time frame analysis, because I'm actually going to switch to my analytical charts now. And there's a couple of techniques I have on there that are not really related to support and resistance. So I hope this doesn't confuse anyone, confuse the newer traders here. So for my analysis on, let me just spin things over to the charts and we'll work from there. Just bear with me. Okay, so we are sharing right now. Just move that over there. Okay, we have the euro dollar up on the screen right now, and we also have the the euro dollar. So I work with, my main focus during my analysis is the weekly time frame, the daily time frame, the H4 time frame, and the H1 time frame. And what I do is I use the weekly and daily scales to gauge higher time frame direction, and combine this with the H4 and H1 to help show shorter term, helps show the shorter term flow, if you will, or shorter term direction. Of course, some traders may prefer to add the M5, the 5-minute, 15-minute, or something like that. But that's absolutely fine, and that's a great thing about trading. We're able to maneuver things into a system that we personally feel comfortable with. So, okay, so kicking off, as you can see here, we have a Quasimodo support. I hope you recognize this one first, guys. This is the weekly time frame. Quasimodo support, clear left shoulder, a clear high, clear low, and a clear subsequent rally to the upside. Now, according to my analysis, we have retested this resistance area here, this long-term resistance area at this point here. And we are now, we've retested this at the beginning of January. And this shows we could potentially be looking at lower prices on the EU. Okay, so this tells me on the weekly time frame we have a bearish setting at the moment. There's a quick question here. I won't try and pronounce your name. I apologize. Can I get the video? Yes, you can. There's a recording, and this will be available at the end of the presentation via YouTube or again on FP Markets. So look, on the weekly time frame, we have a bearish perspective. We know we've retested a resistance area. We know that the sentiment has been largely lower. This is trend studies. So we know we have consecutive lower lows and lower highs, and lower lows, lower highs. But what also really is really something we should also look at. So that's the weekly time frame. Let's switch over to the monthly time frame now and look at the trend. We often forget about this. We have been lower since mid 08. We've been lower. So as you can see, consecutive lower lows and lower highs, lower lows, lower highs. Now this could be the time we're looking at forming another lower low on the euro, which may be incredible, which could bring us back to bring us back to parity, which wasn't seen since around since 2002. This is just my analysis right now, so yeah, please do bear with me. That's the weekly time frame. So we have a bearish approach from there. Now, with that being said, this is the daily time frame. We have a clear trend line resistance taken from this point here. It's a descending resistance. And we have a decision point. Now, a decision point, some will say are supply, but I've termed it differently, because a decision point for me is something that's done some damage to structure to the left. So as you can see here, there was let me zoom in actually, so it's easier for you guys to see. Okay, so this decision point here, many will claim this is a support supply area, which is fine. Look, I get that, but it's just easier for me to understand the psychology. And this is as a decision point. So a decision was clearly made here. It wasn't formed from anything above. It was simply a decision to break through all of these lows. all of these lows. And this for me was consumed demand. So it's a clear break. So as you can see, price this was highlighted in my yesterday's analysis for traders to be careful of this area. We have a bearish setting on the weekly time frame. We now have a bearish setting on the daily time frame through this decision point and nearby trend line resistance. Now, for those who read my yesterday's market analysis, there are going to be traders. Of course, this is the H4 time frame, right? So we've broken this decision point here. This is another clear decision point. This coming at 113. Spot 1272. As you can see, we have we penetrated the upper edge of this area, which many will take as a bullish signal, and quite rightly so. If you're trading an isolated time frame, you are going to look at this as a bullish signal that could potentially take us to prime resistance at 1386, 1355 at this point here. The problem is we at this point here from this H4, we do not know what we're buying into, but conducting multi-time frame analysis, we do know what we're buying into. We're buying into a serious decision point on the daily time frame. As you can see, we did break above and we are now pulling back. Now, what made things worse is traders we broke let me just highlight this, if I can get hold of the level. This is the 113 psychological level. Now, for many newer traders here, we'll be looking at these. I understand that they'll be looking at these psychological levels to either fade or to break and play the retest. So what happened here, if you can see, let me just zoom this in. The psychological level at 113 was broken, a clear break. Now, this is a very bullish sign. Again, I do get this. And we retested the area. Now, the retest showed a bullish candle, right? This is going to draw in a number of uninformed traders. Now, I don't mean this in a rude way. When I say uninformed, I mean someone that's uninformed of the overall technical picture. So we've bounced from this round number and we've drawn in some buyers. The only issue is, again, while we've got a support area visible on the H4 and also the round number, we are buying into daily time frame decision point, a huge area. Not only this, we have the higher time frame direction pointing south. So anyone trading this break will be looking, too closely to recent. I think it's called recency bias. So you're looking too close to the most recent price action, and you see this area. We're in an uptrend. The immediate trends to the upside, and yes, it is. I agree. We have formed higher lows and higher highs, and higher lows, I should have said. But we are trading into a decision point. So by knowing the multi-time frame analysis, by knowing where we are on the bigger picture, we could have avoided this. We could have potentially avoided this buy here. And so that's one of the main reasons I use this, is to avoid those big obstacles, buying and selling into big obstacles. Now, right now, this is fresh analysis. We have formed what's known as it looks like an AB equals CD pattern on the harmonics side of things. Let me just redraw this in. Yes. So we're actually forming, for any traders here that trade harmonics, a basic approach to harmonics is the AB equals CD pattern. If anyone's interested in harmonic trading, we will have webinars on this shortly. But if you can't wait for that, do check out Scott Carney, his website or his books. I've read his books and they're fantastic, and they really do open your eyes to the harmonics of the markets. So look, the AB equals CD, we have AB equals CD into another decision point at 1267, 1278. I haven't got into the RSIs really, but as you can see on the RSI, on the daily time frame, we have the 50 center line being tested. Now, what this shows is if we break this 50 center line, the average gains will be exceeding the average losses. But if we defend this 50 center line, this confirms or validates the bearish approach we're seeing on the bigger picture. Okay, so I hope I haven't confused too many people, but as you can see, I don't just use support and resistance. I use a number of techniques to understand where we are in the overall picture to avoid any, this was a bull trap, if you think about it. So bullish bulls were trapped here, buyers were trapped here, and they got sold into from this daily decision point. Okay, let me see the questions really quickly. Okay, there was a question. Does a support and resistance become stronger the more times it is touched, or is it likely to break? That's a good question. For me personally, I know traditionally they do say support and resistance becomes stronger the more times it's tested. I do understand that, but for me, if you chop at a tree for so long, it's eventually going to fall down. So the more tests I see as a potential, it's potentially fragile. So I'm always wary. But again, just look at the bigger picture. Look at the overall picture. Look at where we are. And you'll be able to tell if a support or resistance is likely to hold or not. So as for this time frame here, we know we've got a bearish projection on this area. If we come below this support area here, we have, we don't really have much at this side here to really look at. So we've got a potential run back to 1193 on the H4 time frame. Now, what this could do is, you see the retest here on the H1. We've retested the round number and we formed what's known as a shooting star pattern. Now, this was a nice signal because we are now trading in line with the bigger picture. We're selling in line with the bigger picture, and we're taking advantage of all these stop losses below here, right? So there's stop losses below this round number from all those traders that got long at this point here. All those traders that entered long. There are a truckload of sell stops below here. Buy stops because when you buy, you look to sell to close your position. So with those, yes. So with us coming in here, we're actually selling into those buy stops. We're taking advantage of uninformed traders, which is quite cruel to say, but it's the way of the market, unfortunately. Okay, so next question from Pete. What's the difference between SR and supply and demand zones? Look, they are used interchangeably. I do understand that. But for me, let me try and find So let's imagine that these are decision points for me. But again, you can call these supply demand zones if you wish. But a demand zone is more recent. A support or resistance area is more, as you can see here, has more history, if that makes sense. So that's all I define it as. Nothing special. So this is a support and resistance area on the weekly time frame here, but this, as you can see, are demand areas because they're more recent. And that's all. There's nothing else really technical about them, to be honest. Other than that, we have okay. So let me just spin things back to the slides. Okay, Q&A. Guys, if there's any more questions, please do fire them across right now. If not, I will look at wrapping things up. Okay, question quite off topic. Do you focus on one pair to trade or more than one pair? I know I look at more than one currency pair. I know of traders that do focus on only a handful of pairs, and they do very well. But me, I look at a number of currency pairs. I don't actually just look at currency pairs as well. I look at the equity market for risk appetite, and I look at the VIX for sentiment. So as for trading, I do look at a number of. I tend to stick with the majors and the minors. Not so much. I've never traded the exotic currency pairs because I just don't like the volatility is a bit too much for my liking. But yeah, majors and minors. So when I say majors, I'm talking about the euro dollar, the pound dollar, the Aussie dollar, and the minors, the euro pound and pound yen and things like that. But yeah, I look at a number of currency pairs. Another question: how do you handle news with resistance and support levels? For me, I tend to stick away from the news. Like I don't trade the actual news event. If that's the question, I don't trade the news event. If I'm currently in a trade, my trading plan will tell me to reduce risk to break even if possible. If you cannot reduce risk to break even, protect yourself, liquidate the position and get out, because you cannot tell what you're in a 50-50 position then, right? And the volatility could really do some damage to your account. So get out of the position if that's what your trading plan tells you to, or reduce risk to break even and take partial profits. there's no really magic crystal ball for this. It's just common sense, really, guys. It's like there was one trade I was in the pound dollar. I've talked about it before, and I was in the pound dollar. I was long the market, and I didn't listen to I didn't pay attention to my plan. I thought I knew better, and I ended up losing 3 times more than I should have done in a period of seconds. It was a very painful event for me, and a really painful event, but one that I clearly needed to actually draw my attention to how important the rules are, because you made them rules when you were objective and you were unemotional, and you've made them rules and you've tested them rules. They work. Why would you not follow them? It just makes no sense to me. Okay, so that seems to be all the questions. Right, let me just check. Just bear with me a minute. Okay, so webinars. So let me just wrap this up. So as I said, this is probably all I've got time for today, guys. Any comments or feedback, please send. This is the wrong email. I'm so sorry about this, guys. This is this should be at support@fpmarkets.com. I apologize. support@fpmarkets.com. And alternatively, if you really want to get send an email to the research team, Market Analyst at fpmarkets.com. So upcoming webinars for this month are the Introduction to Technical Indicators. That's on the 10th of this month. What's an economic calendar and how do we use it? That's on the 17th of this month. And finally, we'll be looking at trading psychology. And this is a very important one, guys. And that's on the 24th. And that's all at the same time. Also, do make sure to register for the FP Markets Telegram channel to get your instant updates on the markets and what's going on. I'm active on there quite a bit now. So yeah, so I post charts regularly and market updates and things like that. So yeah, do be sure to register for that. Okay, brilliant. Do understand that there's a multi-time frame approach it really opens your eyes to the obstacles you could potentially buy into. That euro dollar example I showed is a perfect example of why multi-time frame analysis technical analysis is important. And many newer traders, unfortunately, focus on just a moving average crossover. It's not as simple as that. It really isn't. If it was, we'd be all millionaires by now by just looking at a moving average crossover. Unfortunately, it doesn't work like that. There's informed traders, then there's uninformed traders. Let's not be the uninformed trader. Let's be the informed trader and know where we are on the charts. So on that note, I hope, as I said, this has been beneficial. And thank you very much for taking the time out of your day to attend this presentation. Yeah, so look, have a great day, and I'll catch you all very, very soon. Thank you very much.